Frankly, lot of market so-called investors, when they invest, they simply map and they simply follow good quality investors. And there's nothing wrong in it. It's called cloning. And there is enough global data which says that if you would have just cloned Buffett's portfolio, if Buffett has made 22% on a CAGR basis for an extended period of time, by cloning his portfolio when the information was out, you would have made 18-19%, which is not a bad return. I mean, Ashish also is known, he's very connected with the inner circles of the markets. I can officially say like he's one of the smartest mid-cap stock picker, at least when it comes to D Street. And another very smart stock picker is Nilesh Shah. He's got years and years of experience and needs no introduction whatsoever. He's on a mission now to educate Indian investors how they should be doing the right asset allocation and why every Indian and how can every Indian participate in this Rise with India theme. Nilesh, always fantastic to have you back on ET Now, and thank you for joining us. Nilesh, I'll start with something which in a sense was a concern last month when the mutual fund data for the month of March came out. It appeared that the SIP flows and the mutual fund collections were coming down. So what's the update after that? I haven't spoken to you after that. I mean, is the picture looking okay, or March was now an aberration?
So March was a normal month, but people who interpreted data were in aberration. They failed to understand that in equity mutual fund, there is pure equity mutual fund where we go and invest into direct equity, and there are also arbitrage funds where we invest in equity and short the futures. Now, impact of flows in a pure equity fund and arbitrage fund is completely different. When there are flows in pure equity fund and we buy, the stock prices can go up. But when there are flows in arbitrage fund and we invest that money, it's unlikely to have any impact on prices because we are hedging ourselves by shorting in future. So this is like apple and oranges. Now people who just looked it from top realized that, oh, there is a massive drop in the mutual fund flows. They didn't realize that the flows had dropped in arbitrage fund. March is the month where corporate investors, treasury investors book their profit, take their cash out. So there was redemptions in arbitrage fund, not in pure equity fund. Now this simple fact was missed by all the analysts who were crying, or maybe they were the bears who wanted markets to come down and they just needed a reason. Whichever way, the flows in mutual funds have continued very, very nicely. More importantly, these flows are coming with systematic investment plan. We have now almost 7,500 crore plus worth of monthly flows in systematic investment plan. The NPS also has increased their limit for investment in equity. The Provident Fund also may increase their limit to invest in equity. Put NPS, Provident Fund and SIP flows. My guess is that this year we will get anywhere between 1,10,000 crore to 1,25,000 crore from those flows. And of course, then there is, normal flows through systematic transfer plan or lump sum applications in equity funds. So I want to assure your viewers that everything is good in mutual fund industry. Flows are coming reasonably well, and more importantly, it is coming from matured investors who knows that markets can be volatile and they need to be a long-term investors to make money in equity market.
Very, very happy to hear that, Nilesh. And this kind of assurance coming from you means a lot for investors and for our viewers. Nilesh, now let's roll over to the second part. Indians are saving more, and the Economic Times today is also reporting that the deposit growth is at a multi-year low. It means that Indians are not saving or parking the money into just simple vanilla fixed deposits. Nobody's buying those grandmother variety fixed deposits where they found safety. When you say flows are looking strong, what is the nature of the flow like? Is it still towards equity diversified scheme? Is it tilted towards mid cap, small cap? What is the nature of the flow like?
The flows have shifted from retail investors towards pure equity funds through SIP, in balanced funds, in short-term bond funds and credit opportunity funds. there has been virtually no flows or negative flows in fixed income funds. And in fixed income funds, the performance has been fairly erratic in last 1 year plus. At one point of time, we were saying investors that look, in our fixed income funds, the duration fund like gilt or a bond fund will outperform Kotak Bank savings bank account of 6%. Then we brought it down saying that will outperform PSU bank savings bank interest of 3.5%. Then we brought it down saying that will outperform current account of banks at 0%. And we actually for a brief period ended up becoming negative return. This has happened primarily because 10-year yield moved from somewhere around 610, 620 all the way up to 780. And this despite RBI cutting interest rates in between. Today we have a unique scenario after many years where 5-year government securities are yielding more than the 10-year benchmark government security. This kind of waywardness in bond market impacted performance of duration funds, gilt and bond, and hence there we have seen negative flows or very marginal flows. But bulk of the flows in FY18 have come towards equity funds, balanced funds, credit opportunity funds.
Nilesh, morning. Uday Kotak is a rather worried man, and I'm just looking at his tweets. He's put a table saying, interesting table on the impact if oil goes to $85 per barrel, the impact on India GDP between 5 and 1%. And he's a little worried. He's saying that clearly macro headwinds are here even as micro is getting better. Would you agree with him? Because it's getting a little bit of a tough toil. While micros are showing that recovery in earnings, we're already seeing that play out this quarter. It's the macros which are getting a little tough. Globally, money getting more expensive, oil already threatening to go to 80 and who knows even beyond. And the RBI as well managing or rather looking out for the impact of a rising crude on inflation, and thereby maybe it's not going to be a pause for long. How is it that you as a fund manager are balancing between the micros and the macros?
Undoubtedly, Uday has been talking about macro situations improving, deteriorating over a period of time, whereas micro situation is improving. Every dollar of oil increase takes away $1.2 billion from our pocket. Today, clearly oil prices, which we were factoring at $40 to $60 average, has now moved into $60 to $80 range. And certainly higher oil prices has a negative impact on Indian economy. As US interest rate starts moving up, there could be impact on flows into Indian market, either foreign direct investment or foreign portfolio investment, and that again could have impact on our investment scenario. So clearly global interest rates as well as oil both are negative for India. On top of it, there are concerns emanating from those two factors into our macros. One, current account deficit by virtue of higher oil prices could rise into higher zone. 1.5%, 2% is expectations of most analysts. The fiscal deficit, if government decides to absorb price increases on its balance sheet rather than burden the consumer, could have implication, and it could overshoot the target set by the budget FY19. So fiscal and current account deficit both could combine together in terms of deterioration. The implication of that is on our interest rates and currency. Our interest rates in real sense have remained pretty high. There are very few countries in the world where nominal interest rates are as high as Indian real interest rates. And clearly raising interest rates because crude prices are pushing inflation higher will not be productive, because even if we raise interest rates, it's not going to help reduce oil prices. If at all, it's already going to burden our consumers, our manufacturers more by way of higher interest cost when they are actually paying for higher oil prices. So I hope and pray that RBI does take into account that they probably should focus on core inflation beyond food and fuel, and they should let that inflation, which can't be influenced by their interest rate policy, just leave it to the market. Our macro undoubtedly has deteriorated, but on the other hand, micro has started improving significantly. And I'll take liberty to point out certain factors. Baghi 2 movie had bigger opening collection than Bahubali 2, which was a far more grandiose movie. It shows that urban consumption is growing at a reasonable pace. Sonalika Tractors sold 100,000 tractors last year. Mahindra and Mahindra Escorts, they are also following in their in the similar all-time high levels of tractor sales. Clearly that shows that rural economy is doing well. Maruti Baleno has 4 months waiting period. If consumers don't have money, then how come they are waiting for 4 months to get the car? Tata Motors, if you see the commercial vehicle production, it's at all-time high record level. Generally, commercial vehicles are pulse of the market, pulse of the economy. If commercial vehicle sales are happening, certainly economy is rebounding. If we see the cement volume, they are in double-digit growth. The cement numbers for this quarter has come ahead of expectation. If we see variety of other FMCG companies like Dabur and Lever and ITC, their commentary is also positive in terms of rural FMCG growth. Put all these numbers together and you realize that the economy seems to have now rebounded. The momentum is picking up. It's reflected in last 4 months of IIP number, which was above 7%. It's reflected in GST collections, which have crossed 100,000 crore for the first time. So net micro is improving, as Uday mentioned, but at the same time, higher oil prices, high real interest rates, higher current account deficit, potentially higher fiscal deficit does cast a shadow on the macro side.
I didn't know Nilesh Shah's interests are also to track Bollywood or other box office collections. I thought, Nilesh, your interests were very restricted to cricket. But anyway, moving on, before I talk about the consumption trends, I want to pick up on some of the crude sensitives, Nilesh. And, we can see that aviation is really taking a hard knock because of this crude spiral up. We saw that in Interglobe's aviation's numbers. And the president resigning aside, it seems like it's going to be a turbulent, tough ride if crude prices even continue to stay afloat around 70, 75. And I shudder to think what's going to happen if they do spiral up all the way to 80 or 80 and beyond. Because much unlike some of the other consumption plays, pure play, FMCG, what have you, pricing power is not really with aviation. So while your passenger traffic is growing, airlines are unable to hike ticket prices. Do you sense aviation is now in a spot of bother?
So on the aviation side, I remember booking a ticket from Mumbai to Jaipur in 1994 at 4,000 rupees. And today, after 14 years in 2018, my guess is that you could still book Mumbai-Jaipur ticket at 4,000 rupees. In this 24 years actually, crude prices have spiraled, airports have been upgraded, probably cost of aeroplanes would have also increased, yet the consumer fare has remained virtually the same. Now, this, makes a fairly complex scenario for aviation stock. They have seen tremendous growth in airline traffic. We have about 600 planes and America has about 22,000 planes. And yet Delhi's Indira Gandhi International Airport is 16th most busiest airport in the world, ahead of America's John F. Kennedy International Airport at New York. With 600 planes, we are more busy than America at 22,000 planes. Now, of course, we can't take away the credit that Atlanta still remains the #1 airport in the world. But it shows that airline traffic, airline volumes is growing tremendously. And clearly, airline companies at some point of time will decide to move the price increase to the consumers rather than remain competitive and incur losses. So my guess is that if market is priced in that airlines are unlikely to raise passenger fares and continue to suffer losses, then it might be a great time to invest, because it will be futile to assume that airline companies will prefer loss rather than profit.
Pleasure to have you on ET Now. Thank you for joining us, and thank you for cleanly and smoothly and very openly indicating that what flows are and what kind of patterns are visible, at least for mutual fund industry.